All right, folks, it is Wednesday, January 29th, and we're going to kick off this episode of Navigating the Markets. There's a lot of ground to cover, and there's a lot going on even right now after hours with earnings from Microsoft, Meta, Tesla, ServiceNow, sort of mixed results. A lot of these companies selling off at first and then getting bid back up higher, so that's also quite interesting. Of course, if you have any questions throughout the presentation, feel free to ask in the chat. I'll be checking the chat as we get closer towards the end, and I'll try to address those questions. And then at 5:30 sharp, we're going to be pivoting over to the Tesla conference call, as that's where the folks over on Twitter voted where they'd like to see of all the earnings that were out there. That's the one they were interested in. So let's quickly get through our risk disclosure. All trades and investments involve risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. A bit about me. My trading journey began 20 years ago. I know that ages me, but it's been quite a wild journey. Really had a lot of fun learning. Formative years during the great financial crisis, where you could wake up and you'd be in basically a no-bid market. Imagine waking up to a ExxonMobil or a Microsoft that seems to have no bid, a Dow 8000 that's down 600 points, and then a 50 bip emergency rate cut that pushes things right back into positivity for a lower high, only to be sold to make a new low until FASB finally suspends mark to market and we embrace mark to make believe, which allowed a lot of the financials to kind of, well, buy enough time so that they didn't implode. But that was a really important period for me because I was able to get out of the way, but mostly for all the wrong reasons. I was just looking at a big S&P chart, a monthly going back to the dot-com boom and bust. I saw a giant double top and I said, you know what? I'm just going to get out of the way. If we break higher, I'll go back in. Otherwise, I just wanted to liquidate investments, get into cash, because I was just getting a little bit more concerned. There were weird things that were happening over the summer leading into that fall where I liquidated. There was a money market freeze up. There was huge volatility in Japan and China. And I just also kept hearing more and more about how anyone could go into a mortgage broker and get a house or two or three or four by just having a pulse. And all that just kind of concerned me. I had no idea how bad it would get. And boy, that was a great lesson in the sense of learning how important the plumbing is to understand some of the bigger picture macro trends that can impact markets. And that got me from being more of a discretionary trader to more of a systematic trader. That is to say, I let data be my compass. That's the primary drive. It doesn't mean I don't do anything discretionary, but I lean more into systematics for how I navigate a lot of my trading. So that's looking at momentum, price action, options flow, sentiment, positioning, volume profile in the big picture. Sounds like a lot, but when you start to model it out, it becomes easier to manage. I also backtest and build my own models and systems to trade a variety of asset classes. Really, wherever I see the potential for opportunity and there's enough liquidity, I'm willing to consider taking a trade. I co-founded Traderade in 2022, so we are now celebrating our third year. This is our third birthday, third anniversary, whatever you want to call it. Very, very proud of all we've been able to accomplish over these 3 years. It's been a short time, but we've gotten a lot done. And the roadmap for this year is even more exciting. So stay tuned because we have a lot of cool stuff in the pipeline. And I also built a number of unique tools and models. If you saw the SPX options visualizer stream with the dynamic pivots today, for example, I built both of those tools to help traders better navigate these markets, because a lot of the stuff we do as traders can be systematized and automated to reduce the amount of time we grind down our mental capital and our limited time. And that's the whole purpose of making these tools, making more data-driven decisions and saving our time so that we can spend the time trading, doing more executing, doing more finding opportunities, and less just pouring through things that can be done automatically. So let's take a look at the markets here. First, we have the S&P 500 on screen via SPX, the cash index. And even after today's sort of jittery day, where we're down about 0.5%, it doesn't look so bad. We're above the 21-day exponential moving average. We're above the 50-day simple moving average. Momentum is still in positive territory overall. 60, 50, and 6100 are big levels to watch overhead on account of options positioning, which we'll get into in a little bit. But overall, the more diversified index, the S&P 500, looking reasonably good here. The NASDAQ too, although a little less strong than the S&P, a similar look. In fact, it even tested both moving averages, the 21 EMA and the 50 SMA, and was able to bounce off of its lows and close above them both. Momentum is a little weaker on the NASDAQ. There's been a lot of haircuts given to some of these mega caps, including and especially stocks like Nvidia and Broadcom. And there is growing concern about AI capex in a world where folks are starting to question, is it more about efficiency than number of GPUs in light of the DeepSeek news that has come out? And I would just say, there's so many moving parts to this story that it's unclear of yet just how much more efficient they were. But there is enough information to glean from it that doing, let's say, training models with 8-bit floating point precision is a lot less computationally and memory intensive than 32-bit precision. The reason I mention those two figures is DeepSeek focused on 8-bit floating point, right? Most of the majors out there are training on 32-bit because they assume it's going to be more accurate. That gives you more granularity. If you think about what these models are, these transformer language learning models, they're basically large multiplication matrices of inferred relationships between words, numbers, and phrases. So taking some of that granularity away isn't necessarily a bad thing as long as we're not going too far down, right? You don't want to go much below 8 on that training regimen and much below 4-bit quantization when you're actually doing local inference. Suffice it to say, this has shaken up some of the AI thesis for infinite GPU demand. And I think that's something we need to take into consideration because it's likely that efficiency for whatever ends up happening with DeepSeek and whatever the true story is, it still is in the forefront of investors' minds and in the minds of a lot of AI folks, the engineers and the entrepreneurs out there. Moving on to the Russell 2000, it just doesn't look as good as its brethren, the NASDAQ or the S&P. It closed again below the 50-day moving average, and we can see that's formidable resistance. Multiple rejections at the 50-day moving average. Momentum dropping off, still positive overall, but it's really important that this can hold the 21-day EMA. 3 tests in a row, that many knocks with momentum starting to slump lower gives me a sense that the small caps may be increasingly challenged, particularly if long end rates start to rise again. Saw a little hint of that in the aftermath of the Fed's release of their "we're not going to cut" and slightly more hawkish language about what may necessitate a cut, essentially focusing on labor market weakness and inflation coming down as what either or both being catalysts for them resuming their cutting cycle. And that's going to be important for the Russell, but what's really important is really the 10-year note, because that's also an area where you can see an inverse relationship between the Russell and the 10s. So if you want to get a sense as to where small caps may be going, one of the easiest places to look is what are rates doing on the longer end, because often is the case when financial conditions loosen, when those rates come down, small caps benefit and vice versa. Nvidia, everyone's talking about this company. It had the largest market capitalization wipeout in its history on Monday, losing nearly $600 billion in a single day. And the next day popping up about $280 billion, which was the largest gain in its history in a single day. Put that all into perspective. Last year in 2024, the company tacked on a total of about, I want to say, 2.1 trillion of market capitalization. So to see like a little over a third of that wiped out in a single day was kind of a big deal. And when that liquidation happened, it brought down a basket of hedge funds that were leveraging into these AI stocks, right? There's all these different plays that are interconnected. So during Monday's sell-off, that liquidation event, there were a lot of sort of babies being thrown out with the bathwater, if you think about it, right? Because if you're long this stuff with leverage and Nvidia is getting liquidated, but maybe you're long some of these other stocks that aren't necessarily impacted negatively the same way, you're still forced selling them. So there were opportunities elsewhere, and we've seen some of these companies bounce back. Some of the ones I mentioned on Monday as looking more attractive, like ASML, Oracle. I still think there's going to be opportunities in this space, and I don't believe that the volatility in these tech peripheral plays, whether it's software or hardware, is quite behind us yet. So I do believe these shakeout events, we could see some more of them, and they're constructive if you're allocating capital into the right place. That's to say, some of those dips should be bought. And Broadcom here, overall charts actually looking pretty good after that big haircut. and that sort of double top that we saw. We could still see a gap fill back down here to like 185. Wouldn't be terribly surprising. But right now, I like that we're at the very least holding that 50-day moving average. So we'll be watching this one a little early to get too excited about it, but nevertheless, good to see that it's holding up a little bit better than NVIDIA here. Similar narrative powering its price action higher, that idea that AI is going to drive more and more demand for its semis. And then we have Taiwan Semi on screen. And this one looks much better than the other two overall. It just kind of looks like it's still grinding up into an uptrend. It got a little ahead of itself. You had that big haircut, but Taiwan Semi is kind of the indispensable manufacturer of global semiconductors. They have the most sophisticated fabrication. They're not going anywhere. They're not necessarily a monopoly, but they're pretty darn close. And then there's the broader semiconductor index, which I want to say the weighting on this thing is what, 20, 25% NVIDIA? And a lot, I think another like 11% TSM. So a lot of this index is those two stocks, but nevertheless, the technicals on SMH are quite poor. Momentum favors the sellers. We can see the MACD histogram rolling lower as well. Prices below the 21-day EMA and 50-day SMA. And so overall, this is one to be a little bit cautious of. Just the whole narrative in the semi space is shifting right now. Again, that doesn't mean there won't be opportunities. There certainly are in the space, ASML being one of them. I think they bounce back pretty well. But on the other side of it, you got to be careful what you're buying, what its relative valuation is, and what headwinds and tailwinds it has that could drive that individual company, particularly as we're in earnings season. Another one to watch that's been beaten down on account of the same upending of the AI narrative, because remember the narrative was unlimited energy demand forever. That AI was going to crowd out everything else on the grid, which I think there's a lot of other folks that would want to have a conversation about that because we enjoy having our lights on, for example. But nevertheless, utilities on screen rejected from the 21-day EMA earlier on Monday. Hard rejection off the 50-day in that sell down. And this is a story of the presumption that power demand may not be what some of those more optimistic models were suggesting in terms of its growth. One to keep an eye on, though, I do think that once this shakes out, some of the better companies in the space will be worth going long. And overbought, no more. We have seen the stock market's breadth measure come down a bit, but it was becoming exhaustive. So this was really good to see the number of New York Stock Exchange listed stocks or percentage thereof above the 20-day moving average coming down now to a more healthy level of about 65.59. They were at 74.07, that last marker you can see on the chart here. And you can also see prior occasions when we get really elevated often lead to narrowing breadth. And that narrowing breadth is generally during a sell down. So seeing that, sort of coming off of those highs, it doesn't mean we're out of the woods yet, but it does reduce at least the exhaustion-driven sell-down risk that we had going into this week that I talked about on Sunday's market prep. Now, when we're looking at the S&P 500 options complex, we are continuing to see positions rolling higher overall. We did interestingly see a lot of positioning go to SPX 5000 though. That's something to keep an eye on, and I will monitor that and what the implications may be. But overall, more of that positioning moving higher to the 6050, 6100, 6150, and 6200 strikes. This is overall constructive. Being above 6,000 is overall constructive. I would assume that's going to be a pretty major level of support. And if we do crack it, it is a vol trigger. It could lead to deeper selling and much more realized volatility. In terms of gamma exposure, well, we're pretty much neutral. We're pretty much right at the gamma flip. Spot S&P cash closing 60.39, gamma flip at 60.40. What that tells you is that dealer hedging flows won't be quite as impacted. So we're not going to be in that environment of chase in negative gamma where dealers may be selling dips and buying rips any more than we're going to be in that positive gamma environment where the opposite is true, where they're selling rips and buying dips. So we're kind of just in an environment where that impact is mitigated. So it's much more about the flow, the price action, and the catalysts right now. And the catalysts this week are earnings and macro data, as well as how the market parses that Powell press conference and the Fed decision that was really something I think most of us expected in advance. I don't think many people realistically expected that Trump's decree of cut interest rates now was going to be taken seriously by a Fed that has few reasons to do so. This is not like 2020, or this is not like 2018. Now, key SPX levels to watch for the rest of this week: the call wall at 6,200. The gamma flip we just went over around 60.40, the vol trigger at 6,000, and then a put wall that has moved quite a bit lower now to 5,800 as we see more demand for hedges at these lower prices. Now let's move right along into the big picture because there's some ground to cover here on some of the macro elements. One of which is, isn't it interesting that this bull run in the dollar that we've seen that has really picked up since later September has had everything to do with expectations about the Fed and rates. You can see that the dollar has rallied as the probabilities of the Federal Reserve holding interest rates steady has increased to nearly 100%. Now, I think these are very much related in the sense that the Fed, when it is cutting rates, it tends to be somewhat bad for the dollar. Obviously, this cutting cycle hasn't necessarily had that impact, but that's also because the bond market has fought the Fed and overall won, right? The long end has continued to move higher despite those 100 bips of rate cuts, which really primarily affects the shorter end. But nevertheless, this gives you a sense that as long as the Fed is content to hold rates higher, the dollar could remain well bid. Positioning in the dollar is very lopsided long, so we could still have some consolidation or even a corrective impulse. But overall, as long as rates on the long end are staying above 4.5% on the 10s and even grinding higher, and as long as the Fed seems to be wanting to sit on their hands and kind of have this hawkish pause, overall, the dollar has some support here. The other element to watch is this trend change. We had a long-term bull market in bonds, about a 30-plus year bull market in 10s. That ended over the last several years, and we can see that in this trend chart. It's very clean in the terms of the shift to an uptrend. Now we're sort of consolidating after breaking out to rates we haven't seen in many years recently, and I think that's something we have to pay attention to as well. Now, if you zoom out to 1790, this is about the average interest rate that we've been at. It's around 4.7% actually. So it's nothing extraordinary. But if you imagine a world where there's hundreds of trillions of dollars of debt and about 100 trillion of that swath is keying off of 10-year rates, rates moving higher means pulling back liquidity for global markets, right? It means there's less capital available to chase investments because it's paying down interest on debt that is rising. And sticky inflation, this is one reason the Fed identified that they don't want to cut right now because they're not seeing the kind of progress in inflation that would give them some sense of comfort that they're making the right decision by cutting interest rates into an environment of the market at or near all-time highs, housing at or near all-time highs, gold prices at or near all-time highs, crypto at or near all-time highs, financial conditions tightening, but only at the margins overall. Not a lot of compelling reasons. And if you say, well, it's the government's burden, it's their interest burden on the debt, that's all well and good, but 100 bips of Fed cuts didn't do much to put a dent in it because the rates market has largely rebelled against the Fed, saying, you know what, too much, too fast. We need to see the economy slow and inflation cool down before we feel comfortable. And ultimately, the Fed comes out and makes suggestions about where interest rates should go, but they are not the entire market. And if we look at tariffs, which there's been a lot of discussion about what may happen as a result of that. Goldman came out with a research note recently saying their base case is tariffs would only provide a modest and one-time, basically 0.33% boost to inflation, causing it to fall by less than it otherwise, but not to rise. Now, this may be an optimistic base case. We have yet to see how this all plays out, but it's very interesting that you already see the Wall Street banks trying to model out what this is going to look like and taking a very optimistic view when there's really no certainty as to where this policy will go from here. On the other side of it, however, the world's uncertainty hedge, gold, isn't really buying it. There's so much demand for gold because of increasing uncertainty in fiscal policy, monetary policy, geopolitics. A lot of that supports flows into gold. We can see COMEX gold inventories are growing. We can see gold nearing all-time highs again. And we can see the uncertainty hedge, I think, getting back to $3,000 in the first half of this year. That's my base case. And I've been saying that for quite a while now. I said, look for $2,700 gold in the summer of last year. By September, we saw it. And then at that point, I said, okay, 3,000 the first half of 2025 is very likely. I stand by that. I still think it's likely we see it. And here's one reason why. Gold has found itself more and more resilient against real yields. You can see for a long time, there is this positive correlation between inverted real yields and the price of gold. That is to say, a negative correlation with real yields and the price of gold. Otherwise said that when yields went higher, gold was not happy. That is not the case anymore. And one of the demarcations in this timeline you can see is freezing of Russian central bank assets. Think about that for a moment and what that means. What that really means is that global central banks, which have been buying gold hand over fist, are helping to support prices moving higher because they're more concerned about having their assets frozen than being able to get involved with US paper at better and better rates. That's really what that's telling you. It's not a death knell for the dollar. There's a lot of people that come out and say, oh, the dollar's going to die. It's going to zero. All fiat is in a race to the bottom. The dollar is among the strongest in terms of where it will be relative to a lot of these other currencies. I'm not worried about the dollar versus the euro or the dollar versus the yen or the pound sterling or the Aussie or the Kiwi or the Canadian loonie. But the dollar versus gold, that's another story. The dollar versus what you have to pay for goods and services, that's another story. And that's where you can continue to see depreciation, particularly if we have another strong fiscal impulse or if the Fed gets too foolhardy about cutting rates. Now, this is not your daddy's stock market. This is your grandparents' stock market, or maybe your great-grandparents' stock market. The rise in the S&P 500 over the last 2 years has been the strongest since 1928. That's pretty incredible for two back-to-back calendar years. And to me, it tells me we're pulling forward a lot of future returns into the present. Some of the larger banks have come out and said similar that you may expect the next 5 or 10 years, unless earnings growth really improves, you may see substandard returns. This is also a compelling reason to look at other asset classes and other geographies and other sectors and industries for opportunity, because much of this has been concentrated in a handful of stocks. The other concern is that tech valuations have soared relative to sales. This means tech really isn't cheap unless they can deliver very strong earnings performance. And obviously this earnings season is going to be incredibly important for that. And we'll be covering the Tesla call in just about 7.5 minutes here. So stay tuned because that's going to be part of kind of deciphering the tea leaves as to what's going on. Tesla came in with the double miss, but shares are bid up after hours last I looked. It's a very interesting environment right now. Another area that is showing us a little bit of lofty valuations is the S&P 500's CAPE ratio has only been this high during the late 90s and in 2021. This is not a cheap market, particularly because the indices are weighted towards market capitalization and the highest weighted stocks are quite expensive. If you go to the inglorious S&P 493 where earnings growth should be improving as Mag 7 earnings growth slows, there could be better opportunities there where the growth is strongest versus the Mag 7. In fact, Mag 7 profit growth slowed in Q4 based on estimates. We'll get some more color on that over all these earnings releases, but we're seeing that in Tesla to some degree with Microsoft. Their cloud is also slowing. I will be pouring through the meta results shortly as well to see what all is going there, and I'll share my thoughts with some of you all on the Traderade Discord tomorrow in the Markets and Mayhem chat room about all these earnings and what they mean for big tech and the broader markets. Another interesting note is it's not just folks like me that are looking at this stuff and saying, well, there could be some risk here. Corporate insiders are dumping shares at a record pace. That's something to also concern ourselves with just a little bit. right? It doesn't mean they're all selling for the same reason, but some of them are certainly selling because they think their stocks are getting expensive. They'd like to cash in on those gains after a record 2-year run. And tech is also set to spend about, well, actually over $250 billion on AI-centric data center infrastructure between Microsoft, Amazon, Google, Meta, and Oracle this year. That's a big deal. Some of this may change as a result of recent news. So it's going to be also important to parse these conference calls and see what these companies are telling us regarding their CapEx projections on AI for 2025. Moving right along, unrealized losses on investment securities at FDIC insured institutions are well off their worst levels, which is encouraging, but we're not quite out of the woods yet. So something to keep in the back of your mind, but overall, we've gotten through the worst part of this. It doesn't look like we're necessarily going to go back to those enormous losses we saw unless the long end really zooms higher, because a lot of these securities are longer duration, whether it's mortgage paper, treasury paper, things like that. As rates go up, their values go down. So right now we're looking reasonably good. But again, if like the 10 gets to 5.5% this year, and some analysts are looking for that, this chart could look pretty ugly again, and some of those regionals could be under pressure. Finally, China continuing to show lackluster economic data. Factory activity unexpectedly slow. This was one of the key data points for China's strength. Exports driving factory activity. Now even that is rolling over. So the idea of Chinese stimulus, at least piecemeal stimulus, is becoming more tangible as we get these disfavorable data points. Now, I've shared some great opportunities on the Discord recently. Feel free to check those out. One of them is getting quite close to our price target, so we'll probably be exiting that, and I'll be sharing some other opportunities in light of all of what's happened with these sort of dislocations in the market. So now I'd like to very quickly go to Q&A. If anyone has any questions, let me know. We are going to be wrapping this up in just under 4 minutes. Slowdown asks, given what you said about the last 2 years, is it still a good idea to be dollar cost averaging into the S&P 500 or NASDAQ ETFs, SPY and QQQ? That is a wonderful question. Right now, I'm much more bullish on RSP. That's the equal weighted S&P 500 ETF. And QQQE, that's the equal weighted NASDAQ ETF. I'd rather be in the equal weights to give the other parts of the market an opportunity to outperform here, as earnings suggest that they may. So I love that question because that touches on a key theme for this year. RSP and QQQE instead of SPY and QQQ. That's where I would want a dollar cost average into, looking at where I feel like there could be opportunities domestically in a ETF or index type of fund. So I'm going to cap it there so we can get over to the Tesla earnings call, which is going to start in just about 2 minutes. Thanks for the awesome question, Slowdown. Wags also says, thanks, Markets and Mayhem. Very nice overview as always. Thank you, my brother. I appreciate you as always as well. So we're going to get right over to that call. Thank you all for tuning in to this edition of Navigating the Markets, and stay tuned.